Crypto arbitrage. Cryptocurrency trading has gained significant popularity over the past decade, driven by the decentralized nature of digital currencies, technological innovation, and the potential for high profits. Among the various strategies traders use to capitalize on market fluctuations, crypto arbitrage has emerged as one of the most interesting and potentially profitable techniques. Arbitrage, in its simplest form, is the act of exploiting price discrepancies of an asset across different markets. In the context of cryptocurrency, it involves purchasing a digital currency at a lower price on one exchange and simultaneously selling it at a higher price on another exchange, thereby making a profit. The reason crypto arbitrage opportunities exist is because of the decentralized nature of cryptocurrencies. There are hundreds of cryptocurrency exchanges worldwide, each operating independently with different liquidity levels, transaction fees, and varying levels of demand for specific coins. These exchanges may not always have synchronized prices, which creates an opportunity for arbitrage. However, crypto arbitrage is not as simple as it sounds. To be successful in this strategy, traders must act quickly to capitalize on these price differences before they disappear. Types of crypto arbitrage. Spatial arbitrage. This is the most common form of crypto arbitrage. It involves taking advantage of price differences between two or more exchanges. For example, Bitcoin might be trading for $30,000 on exchange A and $30,500 on exchange B. A trader can buy Bitcoin on exchange A and sell it on exchange B, making a profit of $500 per coin. However, fees such as deposit, withdrawal, and trading fees must be taken into account, as they can significantly reduce profits. Triangular arbitrage. In this type of arbitrage, traders exploit the price differences between three different currencies on the same exchange. For example, a trader might start with Bitcoin, convert it into Ethereum, and then convert the Ethereum into USD. If the rates between these conversions differ from what they would be in a direct exchange, the trader can earn a profit. This strategy requires fast execution and a keen understanding of the market's price movements. Statistical arbitrage. This strategy uses complex algorithms and statistical models to predict price movements and identify potential arbitrage opportunities. This method is generally used by institutional traders or those with advanced technological resources, as it requires high-frequency trading systems and data analysis. Challenges in crypto arbitrage. Speed and timing. The crypto market is highly volatile, and prices can change in seconds. This means that an arbitrage opportunity might exist for only a short window, requiring swift action from traders. Additionally, the time it takes to transfer funds between exchanges can eat into potential profits. Transaction fees. Each exchange charges fees for deposits, withdrawals, and trades. These costs can add up, especially when transferring large amounts of cryptocurrency between platforms. Therefore, a trader needs to calculate the fees involved and ensure that the arbitrage opportunity still remains profitable after accounting for these charges. Liquidity. Arbitrage opportunities are more profitable in markets with high liquidity, as the larger volume of trades reduces the impact of price slippage. In markets with low liquidity, the price may fluctuate significantly during the process of buying and selling, potentially eroding the profit margin. Regulatory risks. Some countries have stricter regulations on cryptocurrency trading, and exchanges operating in these regions may have more regulatory scrutiny. Additionally, arbitrage trading across different jurisdictions can pose legal challenges, and traders need to be aware of local laws and tax implications. Conclusion. Crypto arbitrage is an intriguing and potentially lucrative strategy for cryptocurrency traders, offering a way to make profits without taking on directional market risk. However, successful execution requires quick decision-making, a deep understanding of market dynamics, and the ability to factor in transaction costs and risks. With the right tools, resources, and knowledge, crypto arbitrage can be an excellent way to leverage price discrepancies in the crypto market and make profitable trades.